Hi, everybody. Welcome. This is Jeffrey Dunyan. I am the founder and CEO of Safe Option Strategies, and I appreciate you taking time out of your schedule, wherever you might be in the country or in the world, to join us for this presentation. This is going to be a pretty full class tonight. I've got a lot of people that signed up for this particular time spot, and it looks like a lot of people are logging in. I have with me tonight Kevin Hurley. Kevin is a registered investment advisor. He trades other people's money for a living. He uses the strategies that we teach at Safe Option Strategies to manage millions and millions of dollars for other people in the market. And without getting paid anything for doing so, he joins me on these presentations to help me present what it is we're doing here at Safe Option Strategies, and really to try and teach you something that you can leave tonight with, having gained some benefit. Obviously, we're going to introduce you to our education program, but this is not going to be a big sales pitch. We want you to leave tonight having learned something that you were unaware of before, something that may help you with your trading. I'm going to turn the mic over to Kevin for a minute and let him make a couple of quick introductions, and then we will dive in. We've got a lot of information to cover. I want to make sure we cover it all and be respectful of your time.
Hey, I appreciate letting me be here, Jeffrey. It's always fun to share a little bit about what I see in the market. And more importantly, it's always fun to work with someone that really cares enough about the individual investor out there, the small guy, to help them be successful. It's my belief that honestly, no one can afford to be losing money in today's market, that we're all in it for our retirements, that we're all in it for our future in some way, shape, or form. And again, it's a pleasure to be with someone that cares enough to help out the little guys to make sure that we just don't get taken all the time by the big guys. Thanks for having me here, Jeff. And again, appreciate the opportunity to be here with you guys tonight.
Thanks, Kevin. I appreciate that. Like I said, Kevin gives his time freely to be here. Doesn't get paid anything for this. He's not an employee of Safe Option Strategies. Kevin and I have known each other for over a dozen years. We collaborate on a lot of the trades that we place, him for his clients and me for helping to educate students. Let me tell you a little bit about how things are going to work tonight. There are three main topics that I want to cover, and I want to do it efficiently. I want to make sure we don't leave anything unsaid, make sure we cover everything. But I also want to make sure we go through it slow enough and thoroughly enough that your questions are answered. And that means that as we're going along, you are welcome to type in questions. If the question you type in is appropriate to what we're talking about right at that time, we'll go ahead and insert that, and we'll address the question then. A lot of times the questions we get asked during a presentation like this, we know we're going to cover that information in the next 5 minutes or in the next 10 minutes or whatever the case might be. And so it may appear that we're missing a question, but we're really not. We know we're going to get to it. And then when we get to the end of the presentation, we're gonna open it up to question and answer. And I've already checked with Kevin. He said his schedule is open such that he can stay for as long as needs be to make sure that all of your questions are answered. So with that said, let's get going. The three things that I want to cover tonight, number one, are spotting trend changes. It is so important in today's market to not get pushed around and to not make reactive moves based on a 1 or a 2-day move in the stock that you're trading. And that means whether you're trading the stock itself, whether you're trading options around that stock, whether you're trading futures, whether you're trading commodities, whatever it may be. A 1 and a 2-day price move, a 3-day price move sometimes is not the same as a trend change. And too many people make too many buy or sell moves in the market based on 1 or 2-day moves in the price of a stock they're trading, rather than waiting and watching for trend changes. We're going to talk to you about how to spot the difference and how to be better at that. The next thing I want to talk to you about tonight is how to protect not only your principal, not only the money that you're putting into the market, but how to protect your profits. A lot of people think if they don't ever lose that initial investment that they went in with, they're okay. Making some profit and then losing a little bit of that profit, that's not too bad a deal. I don't like losing any money anytime ever. The reality is you're going to take some losses from time to time. But if you can learn how to protect all of your principal and in most cases the majority, if not all of your profit, that is a fantastic spot to be in. I'm going to introduce, now some of you have heard of it before, but for most of you, I'm going to introduce a concept to you called trade adjusting, or how to adjust trades. And it is really the key to being able to protect yourself when a trend change comes along or when the market moves on you. The last thing we're going to talk about is how to profit through one of these trend changes. So we want to go a step beyond just protecting our principal and the profits we've made on the trades that we're doing right, and we want to get into how can I actually profit if something goes against me, or get myself in a situation with a low risk or a zero risk trade such that I can profit regardless of what's going on in the market, regardless of what happens. So these are the three main topics that we want to cover, and they're all going to tie in quite nicely. Now, the first thing I want to do to introduce the topic of spotting these trend changes, I've got a fairly recent chart, 3-month chart of the Dow Jones Industrial Average. And before I go too deeply into this, I want to give the mic back to Kevin and have him comment on this a little bit. And Kevin, if you would not mind, I would like it if you would specifically share with the folks that are on with us in this presentation the story you told me about a person that you're trading money for, or I think you were going to trade money for him, I can't remember, but I want you to share with us what happened to this individual. And I even circled the day. I kind of did it in a bad color there. Here's a color that will show up a little bit better. I even circled the day that you told me about what happened to this gentleman. So I'm going to give the mic back to you for a minute and let you talk about this, and then I'll talk about spotting some of these trend changes.
Hey, thanks. You know, the reality is there are a couple things that I see as being big problems for people. Because our market's gone up to 17,000 now, we still look at a market where a 100-point move is a big or a huge move. And a 100-point move seems to be shaking people out of trades when it's just standard market movement. I also tend to see people breaking even or not making money in today's market, which to me seems like there's something wrong there. We've had a pretty bullish market, 6% plus, almost 7% now on the S&P, 4% plus on the NASDAQ. For lack of a better term, there's no reason people shouldn't be making money in today's market. Jeffrey circled a day. I received a phone call from a gentleman that gave me a call that I was going to trade money for, but he then traded some money for himself. Literally lost probably over 10% in a month. And I asked him, well, what did you do? I mean, what's going on? Why are you down 10%? And he basically just said, you know what? I blew out of everything today. Well, what does that mean? I closed every single position down. The market was down like 77 points. And I had to ask why. You know, I just had to ask why. And the short answer was he couldn't take anymore. His methodology or his system of trading didn't allow him for a 77-point movement on a 16,600, Dow. I was shocked. I basically just said, well, what did it cost you? Oh, about 12,500. As we did the calculations, because at the end of the day, of course, the market was up 40 or 50 points. At the end of the day, of course, if he had just kept his positions, he would have been up about 2,500. It was a 15-point swing because his trading strategy, his trading methodology, truly didn't give him the ability to let the market do nothing but move like it's supposed to. Shocking. I'm still shocked at the number of conversations I hear from people who are down high single digits, low double digits in today's market, Jeff. Please show us how to spot a trend change.
Well, spotting a trend change is to start out, you need to know what a trend change is. I mean, a trend change is not a 1 or a 2-day move down, because oftentimes in a very bullish market, this has been very bullish the past few. This screenshot was taken a couple weeks ago, but this is a very bullish pattern that we've had going for the last several months. But these moves of being up significantly for a day, down significantly for a day, or even 2 or 3 days, these are not trend changes. Like Kevin was saying, these are everyday moves in the market. These are commonplace, and yet most people will react to these moves. The gentleman that Kevin was telling you about, if I can do it between these arrows that I put on the screen, he was spooked by a day in the Dow that was over 100 points down the day before. The next day, the market opened about where it had started and immediately proceeded to drop another 50, 60, I think at one point 70 points down during the day. Blew out of all of his positions, and by the time it was too late to recover anything, the market had been up over 120, 130 points and settled in for the day around 110 points up from its lowest point, I believe. I might be off a little bit on those numbers. Those are pretty close. He reacted to something that was going on instead of recognizing, following the trend changes. A trend change is more than 1 week's move in a certain direction by a stock or by the market in general, more than a week, or more than a couple percent. You need to be 3-4% move in a certain direction to really be considered something of a trend change or a momentum change, and not these days that are down quickly followed by these days that are up. I mean, look at how many times this has happened just in the last couple of months. There's several days. I just circled several days up followed by a couple days down that gave almost that exact dollar amount back in the Dow. Few more days up, one day gives most of that back from those 3 days of upward movement. Recently, a couple weeks ago, there were 3 out of 5 days during the trading week that the Dow Jones Industrial Average was down, and you would have thought that the sky was falling. Chicken Little was running around telling everyone the sky is falling, the sky is falling, the market's going into its big correction. But look what happened in the next few days after that. And the Dow is, like I said, this chart's a couple weeks old. The Dow has continued to be bullish since then. Trend changes are when you get a sustained movement in one direction or another. Now, one thing not to do is not to react to the 1 or 2 day movements. Another thing not to do is don't get caught up with being paralyzed and not making the move when you should. The idea behind spotting a trend change is knowing when to make a move. You don't want to become so casual and so callous about these moves up and down that you don't do anything. You need to do things when the timing is right. A few months ago, when I was setting up one of these presentations for a group of people like yourself, I brought up this is just a screenshot of when I was setting up stockcharts.com to look the way I want it to look with the 5 and 20 day moving indicators and the MACD and the RSI. And as I was setting this up, I started looking at all the different things that I could put on the screen, all of the different overlays and technical indicators. And these are a few that jumped out to me. Ikimoku cloud. Don't even know what that is. But I'm a glasses half full guy, not a glass half empty guy. So if I can get a full Ikimoku cloud rather than an Ikimoku cloud that's not full, why wouldn't you do that, right? I'm being sarcastic. I hope you're picking up on it. Parabolic SAR, no idea what that is. VWAP, not a clue. Zigzag retrace, no idea. You know why I have no idea what these things are or what they mean? Because they don't matter. They are white noise. They're background noise. They're distractions. They're muddying the water. I mean no disrespect to the people that came up with the mathematic formulas that create these overlays, but you've all heard this popular cliche, paralysis by analysis, or another one that goes with it is information overload. I know people, I have conversations every week with people who are afraid to make a move because they're trying to get 20 or 30 stars to line up right in the cosmos before they'll make a move. And folks, it just doesn't happen, or it happens so rarely that you're going to miss out on the trends. So the two things not to do are don't overreact to a 1 or 2 day movement, but on the flip side of that, don't do nothing. Don't sit on your hands and wait for conditions to be perfect before you do anything. The in-between is follow what works most consistently. This is a stock chart screenshot of Facebook, company that everyone in the free world now is probably familiar with. And a lot of people that don't live in the free world are familiar with Facebook and know what it is. the indicators that will help you recognize actual trend changes are the MACD, the 5 and 20-day exponential moving averages, and the RSI. When the MACD gives you a crossover to the upside, the 5 and 20-day moving averages, when the 5-day moving average crosses above the 20-day moving average, and when the RSI crosses above this middle line, this 50 line. When those three things happen relatively close to the same time, what follows 80% of the time, at least 75 with most stocks 80% of the time, is a continued trend change, not a 1 or 2 or 3 day movement that oftentimes gets reversed in the next couple of days of trading. When the MACD and the 5 and 20-day moving average and the RSI all cross over to the downside, what you usually get 75 to 80% of the time or more is a continued trend change. What you have to be really careful of is not making a move when it gets really, really close but doesn't cross over like it did right here, when it gets really, really close but it doesn't cross over like it did right here, and then you make your move when all three things happen. I say at the same time, but obviously in this case and in this case, the MACD was a leading indicator. It happened a little bit ahead of the other two. That's a fantastic thing. If you use that to your advantage, that means when the MACD crosses over, you start paying closer attention to the other indicators, and you watch for them to cross over. And when all three have crossed over and are moving in the same direction, up or down, you more often than not, 75, 80% of the time, you get a trend change. And notice they don't ever, or at least they very rarely cross over when things are at their highest or when things are at their lowest. And a lot of people get hung up over the movement that they might have missed in between here, or the movement that they might have missed in between here. I hope I don't offend anybody, but that's just plain foolish. You cannot get hung up over this move right here if you're capturing the majority of this move down, if you're capturing the majority of this move up. And by capturing, I mean you're buying at the appropriate times, you're selling at the appropriate times. If you're into option and spread trading, you're putting on spreads at the right time that are bullish spreads, you're putting on spreads at the right time that are bearish spreads. That's all I'm talking about, is putting on the right strategy at the right time. And why wouldn't you wouldn't you follow what has been proven accurate 75 to 80% of the time? I share this with people sometimes as they're investigating or looking at our education program, and I share it with them. You know, obviously I'm teaching it to them if they get into our education program, and I'm a little bit surprised on a regular basis at how they continually forget to follow this. And I ask all the time, why wouldn't you just follow this if it's accurate 75 to 80% of the time? Folks, the reality is most independent traders, most people like yourselves, and this group may be different, but most people like yourselves don't consistently follow these indicators. They get into Fibonacci retracements, and they spend too much time with Ikimoku clouds and VWAPs and parabolic SPWKJ in Houston and Cincinnati. It's just I'm trying to be silly again to make a point, but Kevin, what's a good way to summarize this? There's an acronym that I love that summarizes why you should use these three indicators to determine if a trend is changing or not.
That would be the KISS principle. Keep it simple, stupid.
KISS. Keep it simple. I won't even say the other part of it because I don't want anybody to get upset. But it's thanks, Kevin. Kevin's willing to be the bad guy for me. Keep it simple. It doesn't have to be any more complicated than that to recognize trend changes versus these 1 or 2 day movements. Okay, we're spending enough time on that. Anything else you want to comment on this, Kevin, before we move on?
I'm good. Let's keep going.
Okay, let's keep moving along. The reason I just changed screens, and the reason it says spread trading right here is this. In order to teach you how to protect your profit and your principal, with a concept called trade adjusting, you need to understand that trade adjusting goes hand in hand with spread trading. Now, if you don't spread trade currently, you're still going to understand what we're talking about, because we're simply going to be talking about strategies that take advantage of a bullish direction or strategies that take advantage of a bearish direction. And it doesn't matter if you understand specifically what spread trading is. That is one of the things that we're really, really good at teaching people at Safe Option Strategies. But I will tell you this. If you want to learn how to adjust a trade to follow a direction change of a stock you're trading, you've got to know how to spread trade. That is the foundation of knowing how to adjust trades. Now, what I'm going to have Kevin show you right now is why it is that people can be right 75, 80, 90% of the time in the trades that they place. And what I mean by being right is you can be profitable. You can have chose the correct direction 75, 80% of the time, and yet you can still be losing money overall. And I'm going to have Kevin demonstrate why that happens sometimes.
Thanks, Jeffrey. In fact, I try to warn people, one of the biggest misnomers that people think is very important is that if they have a higher percentage of winning on their trades, that they're making more money. Those are two separate questions. I mean, most people are going to tell you, I've got an 80, 90% winning percentage on the trades I place. Yet in real life, their portfolios are still down. I want to show you guys an example. Let's use our first trade. We're going to follow our market. It's a bullish trade. We're going to do some type of bull spread. It may be a 4-day trade where you get a 20% return. If you're going to compound your interest, you're going to use that whole $1,000 and do a $6,000 trade on your next one. Again, it'll be a bullish trade following the market. Might be 2 weeks. You make a 23% return. You may have $1,380 of profit. Go ahead and compound that interest a little bit more. Third trade is 1 week trade, 18% return. You're doing nothing more than following a bullish trend. You now have over $8,700 in the stock market. Unfortunately, maybe you were foolish enough to place a stop loss on an options trade. Maybe the market scared the 100-point drop the day you placed your trade, and all of a sudden it showed a significant loss. Guys, you have now booked 3 out of 4 trades for a profit. You're at a 75% win ratio, but in real life, I mean, your portfolio is down about 13% for a $646 loss. I see this all the time. Jeffrey, show us what it looks like on a chart so people can see it in real life.
Yeah, so that you don't think this is just a theory or something that's made up or something that's hypothetical. We took the example of these 4 trades off of something that recently happened with a company that you're probably all familiar with. I mean, whether you trade these guys or not doesn't matter. Most people around the world are familiar with Caterpillar. They're a huge company. They're an international company. They're based in the U.S. They're traded on the U.S. markets, but they're an international company. You see Caterpillar equipment all over the world. When Caterpillar is in a bullish trend, and this 3-month chart shows 2 solid months of strong bullish movement on Caterpillar, people place a trade when they get that bullish move happening. And when they close that trade out and book some profits and they add those profits into their principal balance and they place another trade, they continue to follow the trend and they get their next trade. Maybe this trade lasts a little bit longer because the bullish move isn't quite as strong, but they get their profit and they get out and the trend is still bullish and they place another trade. And even though they get a little bit of a move down one day, it's followed by this bullish move. And that's, look how many times that's happened in here. In fact, in this stretch right here, there's more down days than up days, even though the stock was overall bullish during that time. But they're not doing anything wrong by placing one more bullish trade because the trend hasn't changed. But look how suddenly, and if you've been in the market for very long, you have seen this happen before if you've been in the market. Look how suddenly that stock dropped in price. And look at the volume that accompanied it. And this trade now loses money, and based on that example that Kevin was just showing you, you're compounding the interest. You're trying to grow your portfolio faster, so when you make profit, you add it to your principal, and you put that principal and profit back into a trade, and wham, one bad trade that costs you 50% of everything you put into it wipes out all of the profit of the other 3 trades and then some, and you're down. Now, Kevin, go through the same, if you would, please, go through the same 4 trades with the ability to adjust the trades, and we'll talk a little bit about the difference that makes.
I hear a lot of people ask me all the time, because I use these same strategies in an adjustment process in my trading for people. I hear people all the time ask me, well, Kevin, how important is it to really understand an adjustment strategy? This is our example. We're going to give you the same example that we saw before, but with a little twist. We're going to place our first trade. Same trade, it's a 4-day trade, 20% return. We're going to get that same $1,000 of profit. Our second trade, we're going to be a little bit different, though. We're going to prepare the trade just like we did our first, but we're going to do so thinking about our worst case scenario. We're not going to think about our best case. We're going to think about our worst case scenario. This trade, we're not going to be in it for a couple of weeks for a 23% return.
Kevin, yeah. Can I jump in for a second?
Yeah, go ahead.
I'm sorry to interrupt you. If you remember on the screenshot we had before, this was a couple-week trade that had a 23% return on it. When you are learning how to spread trade, and more specifically when you're learning how to adjust trades, you have to start that process by understanding that even though you're following the same trend, the trade itself is going to be set up a little bit different so that it can be adjusted. There's nothing profitable or beneficial or nothing that will give you an advantage knowing how to adjust a trade if you continue to set up trades that cannot be adjusted. People ask me all the time, and this is a very fair question. There's nothing wrong with asking this. Most people that attend this online class that you folks are in right now, most people have participated in or they have looked at other online education. They've compared me already in some way, shape, or form to my competitors, and they ask the question all the time, what is different about safe option strategies? And I'm gonna preempt your question because some of you are thinking about it already. I'm gonna preempt the question and answer it for you right now. Here's what is significantly different at safe option strategies. Instead of just teaching you how to adjust a strategy, how to turn a bull call spread into a bull call calendar or into some type of synthetic collar trade, instead of teaching you how to turn a regular ratio put collar trade into a hook and ladder trade, because that's good information to know, but it's worthless to you. So instead of just teaching you that, we make sure we teach you very thoroughly how to set up trades that can be adjusted. If you have the manual that goes with your automobile that tells you how to fix it, and you have a great set of tools with all the different screwdrivers and wrenches and everything that you need to fix your car, you take off on a road trip and that toolbox and that manual are sitting in your garage at home, you have no ability to fix your car if it breaks down. You left the garage in a vehicle that cannot be fixed because you don't have the tools to fix it. You left them home. Doesn't matter if someone gives you all the tools if they're not teaching you to put them in the trunk, if they're not teaching you to have them with you, if they're not teaching you to prepare for that road trip by having those tools in your possession. We teach you how to set the trade up correctly so that it can be adjusted if the time comes that it needs to be adjusted. Okay, Kevin, I'm going to let you go. Sorry to interrupt you. I'm going to let you go back to what you were talking about.
Not a worry. Just I think you went through it. The short answer is less a return, but we're in the trade less. We only booked $900. Our third trade is a $6,900 trade, doing nothing more than following the trend. Again, we don't book quite as high as a return as last time, but we still book a profit of $1,035. Following that same trend, we place our fourth trade, but we have an adjustment methodology. We have the ability to lessen our loss, or in this case, to break even. We can break even in our trade. Maybe we lose our commissions. much smarter than trying to put a stop loss on an option trade. We still have the same 75% success ratio out of the trades that we traded. But more importantly, the difference is we have a profit of 59%. We're sitting at almost $8,000. We don't have a loss. In fact, it's a 70% difference from those that just book that loss, have that stop loss, tear up their portfolio. It's amazing how many people I've talked to that think they have some type of methodology that allows them to weather the storm until the storm hits, and then it's gone. Guys, it is vitally important to understand how to adjust. Jeffrey, show us what it looks like on a chart.
Same chart, following the same bullish trend, putting on the same, similar trades. I got to be careful, not the same trades, similar trades. Same in the sense that they're taking advantage of the same direction. But in every one of these cases, we're setting up a trade that might be a little more conservative. We may be a little bit farther out in expiration. We may be a little higher or a little bit lower in strike prices. We're going to prepare in advance as we're setting up the trade, as we're getting into it. We're going to prepare to adjust it in case we need to adjust it. And when that fourth trade comes along and it's followed by this right after we get into it, we're not going to take that loss. We're going to move with the new direction and get a break even, maybe a very, very small loss, not much more than what our commissions would be. In many cases, we can adjust these trades and actually be profitable in them. And I ask people this question when I do this presentation. I always want to ask this question. And for those of you that may have been in the market during 2008 and you have literally felt the sting of what I'm going to talk about, I am not trying to pour salt in an open wound, but I want you to try and imagine something. Imagine if you had the ability to turn the clock back 6 or 7 or 8 years. Go back to 2005, 2006. When the markets were incredibly bullish. Go back to the mid-1990s when you could put a list of stock symbols on a wall in your office, blindfold yourselves and throw darts at it, or better yet, blindfold a monkey and have the monkey throw darts at it. And you had a 99.9% chance of whatever stock you picked and how much money you put on it, you were going to make money. Anybody could make money under those conditions. And when those bullish runs in the markets collapsed, people got wiped out. But imagine if you could turn back the clock. And what if safe option strategies could never, ever show you a way to be more profitable on these ones that you're picking correct already? What if we couldn't show you how to be more profitable here? But what if we could teach you how to never take a loss right here again? What if you could actually turn back that clock and say, no one's going to give me extra money for the trades that I was doing well in already, but someone's going to give me back the money that I lost on the trades that went against me? How different would your portfolio be right now? And ask yourself this question. The next time the market goes through a significant correction, do you want to be asking yourself if you can turn back the clock again? Or would you rather set the clock correctly right now so that you don't have to turn the clock back 5 years or 6 years or 8 years down the road when we've been through another big market correction? I know people that in a 40% market correction in 2008 lost fortunes. I know people who lost their entire retirement because they had no clue what to do when the market corrected 40%. Okay, enough of that. We got to move along. The last thing I want to show you, if I can clean up some of these marks on the screen, and Kevin's going to help me out again. I want to show you how you can actually profit through trades that have very little and in some cases no risk to them. Now, don't think that I'm misspeaking right there. And trust me, when the SEC hears me say this, and they've called me a few times, I have to explain it to them. They don't like me saying trades with no risk because they say every trade comes with risk. Bull. You can set up trades that have absolutely no risk in them for a period of time and can still be incredibly profitable. But kind of like we did with technical indicators, I'm going to have Kevin show you what not to do, and then I get to be the knight in shining armor, the hero that rides in and saves the day. I'll be the good guy and show you the right way to do it.
All righty. I talk to people from all over, from Goldman Sachs, from Prudential, from TD Ameritrade. This is their version of a collar trade because they took a test and they think they understand options. Kevin, you're going to buy this stock. It's going to be $28.84. And this guy let me know every penny is at risk in that stock, Kevin, so you have to protect it. So they go and they put on a long put, the right to sell their stock at a certain price for a certain period of time. It's nothing more than insurance on stock. But I got to chuckle because not only does it cost them 72 cents, but they put it out of the money at $28. They're cheap traders. They've left 84 cents of this every penny at risk on the stock at risk. I just chuckle because they beat this into my head, how every penny is at risk, yet they don't even bother to protect every penny. Don't understand it. But putting this into perspective, they have lowered their risk down to $1.56, significantly lower than $28.84. To lower the risk even more, they sell a call. They're now obligated to sell a stock at a certain price for a certain period of time. It gives them a 77-cent credit, which completely pays for that long put. Overall risk in the trade is significantly down from $28.84. It's only 79 cents. Not bad. I got to say, not a bad trade to be in. But the most they can make is 21 cents a share. I don't know about you guys, but I do know I wouldn't want to make one reward for 4 risks. It's just insane. It makes absolutely no sense to me. I see people do this all day long. All day long, I see them set up a collar trade. And this is probably the reason, set it up wrong, but this is probably the reason why most people think you can't make money on a collar trade. Jeffrey, please show us a better way to set up a collar trade.
Almost forgot to unmute my microphone there, and I was going to start talking. You couldn't hear me. Now, folks, I was testing this before we started the class, and I was having a little bit of a struggle with it. One piece of this that I want to show to you is cut off on the bottom of the screen, so I'm going to tell you the numbers as I go through it so that you don't think that there's something wrong with your screen. In preparing to present this information tonight, I wasn't able to quite get the right fix for it. So I'm aware of that in advance, but you'll still get the gist of this. Best Buy, everyone knows who Best Buy is. When we set up this particular trade, Best Buy, like Kevin said, was trading at $28.84. I'm taking prices from the same day in the market. Now this trade, some of you have already noticed, this trade is already 6 or 8 weeks old from the day we took the screenshot of this, but there's a specific reason why we're still showing you something that may look a little bit outdated, that's done intentionally. Instead of getting July options when we set this up, we went to August options. We went out farther in time and gave ourselves a couple of months of time to buy a long put option to go with this stock at 28 strike price for $1.09. Now, what this means, for those of you who may be new to options, whenever I do one of these classes, I know I have at least a few people that are new to options. What we're doing here is buying an insurance policy that allows us to sell our stock at $28 a share between the time we purchase this long put option and the time it expires on the 16th of August. So from the day we set this up, in this case, exactly 2 months. For 2 months, we have an insurance policy on our stock. So if we went out and bought 1,000 shares of Best Buy and spent $28,840 for an additional $1.09 per share, so that's the cost of our insurance. That's like your insurance premium. We have the right to sell Best Buy at $28 a share, and it doesn't matter how far down it might go in price. If Best Buy dropped down to $20 a share, and folks, it was only a few months ago that Best Buy was down at $20 a share, so if you think that couldn't happen in a blink of an eye, think again. And think of that from a percentage standpoint. $28, almost $29 a share down to 20, that's a big percentage drop. That stings people. That's where people lose a lot of money. But we have an insurance policy. Best Buy could go to $20 a share. We can still sell it at 28, but it costs us $1.09 per share. So on 1,000 shares, $1,090 was the cost of our insurance policy, so to speak. Now, again, I know it's cut off at the bottom of your screen, but to help mitigate this cost, to help mitigate it, we're going to also sell a call. Oops, let's see if I can, my screen doesn't want to advance with me here. There it is. Okay. What I'm highlighting at the very bottom of the screen is the January 2016 33 strike price short call. And for those of you new to options, what that means is anytime between now and January option expirations of 2016, that's a year and a half away or more. The person who gives me that money, and they're going to give me $2.96 per share, they have the right to buy my stock away from me at $33 a share. They'll only do that if the stock goes over $33 a share. Now, someone asked a question, couldn't you buy the 29 strike long put for $1.60? Absolutely, you could. There's not only one way to do this. We chose this because it protects the majority of our investment. You certainly could do this. The difference is it costs you 51 cents more per share to protect your stock at $29 instead of $28. You're technically speaking, you're a little bit overinsured. It's a good question, and that's why I answered it now instead of making you wait until the end. So this is less a question of right or wrong. It's just a question of this is the way we chose to do it. Now, we're going to get $2.96 a share for a 33 strike price short call. That $2.96 is way, way more money than what we need to cover this $1.09 per share that we're paying for the protection, for the long put options. So let's spend the rest of it. Let's get twice as many long put contracts as what we need to protect the stock. Now, follow along what this looks like when you're figuring out your cost basis in a trade. We have $28.84 per share invested in the stock. At $1.09 per share, if we buy twice as many as we need, then our average per share relative to the stock is $2.18. Everybody see that I'm doing that? I'm taking this $1.09 and I'm doubling it because we're buying twice as many as we need. So for example, if we had 1,000 shares of stock at $28,840, we would spend $2,180 on long puts. We'd have twice as many. Relative to the price of the stock, our price per share would be $2.18. We have that short call that's paying us. That's money someone else is giving to us at $2.96. That's just equal to the amount of stock that we have. We're not multiplying that or dividing that by anything. That means that our average cost per share for the stock and the options that we have with it is $28.06, with the right to sell at $28 a share, which means we only have 6 cents at risk. And that might answer that. The same gentleman that asked that other question, part of the reason we chose that 28 strike price for $1.09 is because we knew we could double up on those and still only have 6 cents per share at risk. Now, folks, think about what I've just told you, even if you don't know very much about options. What happens now if the stock goes up in price? Our average cost per share, I'm going to answer these questions for you, by the way. Our average price per share is $28.06. If the stock went up in price, we profit up until $33 a share. Remember I told you this was a 33 strike price? We profit right up to $33 a share. Now, someone could buy our shares away from us at $33 a share. I've got my calculator right here so I don't screw it up. $33 a share minus $28.06 would be a profit of $4.94 per share. And if you divide that by your investment of $28.06 per share, that's a 17.6% return. I hope you're not bothered by getting a 17.6% return when you only have 6 cents at risk. 17.6% on $28 when you only have 6 cents per share at risk. Now, that's the easy part. You profit if the stock goes up. You profit up to almost 18% if the stock goes up. What happens if the stock goes down? What happens if we set up this trade and Best Buy were to drop back down to $28 or to, excuse me, from $28.84? What if it were to drop back down to $20 a share? Half of these long put contracts that we've purchased give us the right to sell at 28, and that's why there's only 6 cents per share at risk. What are the other half of those long puts doing at that time? If the stock goes down to $20 a share, how much would these long puts be worth? We paid $1.09 for them. If the stock goes down to $20 a share, we're going to get at least $8 per share if we sell that extra set of long puts that we don't need. They're there for profit. $8 a share on a $1.09 investment, and really not even that, because this paid for that $1.09 investment. Those long put contracts that are in excess of what we need to protect our stock, they are pure profit as the stock is dropping. I can make money if this trade goes up. I can make money if this stock price goes down. And I'm sleeping well at night. For 2 solid months from the time I open this trade until the expiration of my insurance policy, you think I'm losing any sleep at night over 6 cents per share on a $28.06 per share cost? If I had 1,000 shares of this, folks, I have almost $30,000 invested in one position if I did this with 1,000 shares. And the worst thing that could happen to me is I could lose 60 bucks. I will take those odds every day of the week, every minute of every hour of every day of the week, because I've now stacked the deck completely in my favor. I'm the house now. It's all slanted in my favor, no matter what happens in this trade. Now, let me show you a little twist, and then we're going to wrap things up here. What if we did one thing different? We basically structured the same trade with one difference. Instead of getting twice as many long put contracts as we need, what if we got 1.5 times as many long put contracts as we needed? And that still leaves us some money to spare from that $2.96 a share that we took in on covered calls. And what if we spent that on some long call contracts, maybe half as many as what are relative to our stock ownership? So if we had 1,000 shares of stock, 10 contracts of options would cover all 1,000 shares. We would get 5 contracts of long calls. What if we set the trade up this way? Let's look at our cost basis again. $28.84 for the stock. Now we're going to multiply our long put cost per share times 1.5 because we're doing a different ratio of it. We're going to add these long calls here at the $29 strike price. And since we're only doing half as many as are relative to our stock, we're going to divide that by 2 or multiply it by 0.5, whichever makes more sense to you. And then we're going to take in that same money for the short calls. And now our cost per share, our average cost per share is $28.12. So we have 12 cents at risk instead of 6. Wow, we have doubled our risk. I tell my kids all the time, I'm going to double their allowance. And for just a split second, you see the excitement in their eyes for a split second. And then I say, yeah, 0 times 2 is still 0. And now go do the dishes and take out the trash. You're trading that for room and board. I'm kidding. I'm nicer than that to my kids. But 12 cents at risk on almost a $30,000 investment, $120 would be at risk. And now, what happens if the stock goes up? Well, we still have the difference between $28.12 and the $33 strike price that the stock could be bought away from us. So we're only 6 cents difference there. So instead of 17.6% profit there, it's going to be 17.4% profit there. Okay, I hope that's still an okay profit. We still have long puts, not as many. The amount we need covering our shares of stock and half as many making pure profit for us, but there are still a set of long puts out there making pure profit for us. But now think about this. If the stock goes up to $33 a share and someone wants to buy that stock away from us, is there anything keeping these long calls from making more and more and more and more money? If the stock is going over $33 a share, that means these are worth at least $4 a share, and we only paid $1.23 for them. What's $1.23 divided by $4? Whoops, I'm doing that wrong. The difference in that would be $2.77. So it'd be $1.23. Oh no, excuse me, $2.77 divided by $1.23. That'd be a 225% profit on these long calls, in addition to 17% profit on our stock. And we don't even care what's happening to these because this covered call money paid for all of it. Folks, do you see where we're going with this? If you think this is hypothetical, I left this Best Buy trade in this presentation, even though it's a couple months old, or over a month old now, month and a half almost. I left it in this presentation for this reason. In one of our newsletters that goes out to the students of Safe Option Strategies, we set this trade up on Best Buy. And so our students that wanted to follow along with us, the ones that wanted to follow along with us and do this trade, got into this trade exactly the way I'm showing it to you right now. As of today, those individuals who followed us along in this trade are up 33.5% on however many shares they got right here. For those that got in with 500 or 600 or 1,000 shares, they've made some pretty good money in a relatively short period of time and had close to no risk in the process of doing so. Now, if you want to see an even better example of how this works and why this works, at the end of last year, one of my students approached me. Actually, it was just right at the first of this year, just after the end of last year. He said, Jeffrey, can I show you what I've done over the past 30 months? This student's been with me for about 4.5 years now. I said, I'd love to see it. He had shares of First Solar, 500 shares, back in May of 2011. So that's the time period that you're looking at is May of 2011 to December of 2013. 30-month period of time. In May of 2011, he had 500 shares of First Solar, and they were trading at $120 a share. Now, he didn't pay $120 for all those shares. He had built those shares up over time. So some of that $60,000 that he had in this position was already profit. He wanted to protect his profit as well as his principal in this trade. Now, the first thing that you ought to notice when you're looking at this chart is that 30 months later, this stock was trading at $60 a share. At the end of 2013, this stock was worth half of what it was in May of 2011. And at one point in time, it had gotten as low as under $10 a share. If you can see that down towards the bottom of your screen. It got below $10 a share at one point in time. Now, doing exactly to the letter what I just showed you with Best Buy, he added more long put contracts than he needed for those 500 shares, and he paid for all of it with money he took in from short calls that were way out in time. And then using something we showed you earlier, that something would be KISS, keep it simple. When he got these technical crossovers to the upside, he took the profit from the long puts. He didn't take other money in his portfolio. He did not invest other money that he rolled over from another account. He didn't say to his spouse or his partner, hey, could we throw another $40,000 into this trade because the stock's trading at $40 a share right now and I want to get another 1,000 shares. He used profits from those long puts. So relative to the overall trade, he did not increase his cost basis, folks. He repeated the same thing here, only with 1,500 shares instead of 500. And on the KISS, keep it simple, crossovers that came, he added 4,000 more shares to his position. And then he added some long puts on some technical crossovers, and it reversed on him and went back up, and he lost about 500 bucks. And in this little, I like to call these head fakes, between this head fake right here and this head fake right here, where the stock reversed trends and then in a very short time it was reversing the other way, he lost about $1,200 in those two situations. Look really close at this last box that I just brought on the screen. Read that really, really close. Because at the end of 2013, he owned over 6,000 shares of First Solar and had not invested more money from somewhere else in his portfolio into those shares. He had simply leveraged long put and long call profits into more shares when the time was appropriate to do so. And he dollar cost averaged his way into 6,000 shares total. And at $60 a share, half the value they were per share 30 months earlier, he was up 500%. If you're making 500% every 30 months, I would ask you two questions. Why are you in this presentation today? And why aren't you teaching other people what you're doing? Our students are doing things similar to this consistently. Folks, at Safe Option Strategies, we sell an education package. We sell it in two different courses. One course is the Ultimate Collar Trade course that literally teaches you everything to the letter that I just showed you with Best Buy and First Solar that would allow you to do the same thing with those types of trades. This course is taught through 16 online classes. Every one of these 16 online classes is pre-recorded, and we present a couple of classes every week live. So you can go at your own pace through the pre-recorded classes. You don't have to wait for one to be scheduled live. You can watch it when you want to watch it on a recorded one, or you can schedule it the next time it comes around live, or you can do both. And most of our students do both. They go through at their own pace, and they participate in the live classes as they have live interaction with me and with some of our other instructors at Safe Option Strategies. We have a monthly newsletter we send out with this course, and this monthly newsletter outlines every single month we pick a company that has ideal timing to get into a collar trade. And so if our students want to follow along and do trades with us, they can do trades with us. We have a blog site. It's actually been offline for a couple of weeks. It's going back online this week. We've just been updating it and putting some new technology into it. But we have a blog site that we keep track of any adjustment we make to these trades. So our students know when it's time to add long puts. They know when it's time to add short calls. They know when it's time to roll short calls or move those puts farther out in expiration because the stock is still trending down and the long puts are getting close to expiring. We tell them when and how we're going to do that stuff. We have live weekly chat sessions that are just open discussions with our students about what's going on in the market, what's going on with stocks we're trading, what's going on with trades we have open, and what our thoughts are. Some of the best trading ideas I've got over the years are from students that say, hey, Jeffrey, what about this? And I look at it and I say, wow, number one, that's fantastic. You're learning everything really well. And number two, that's a really good trade idea. And this is what we go over in these weekly chat sessions. Full retail cost on this education course is $2,500, but we're offering a discount that we're running. So stay on for a second. I'll tell you what that discount is. The second course, or you can buy one or the other. You don't have to do both courses. Some people don't want to own stock, plain and simple. They just don't want to have 200 or 300 or 1,000 or 10,000 shares of Best Buy or First Solar or Apple or SanDisk or NVIDIA or Ford or whatever. They don't want stock in their portfolio. They want to trade options only. We have a course that's designed for that. Our spread trading course teaches everything you need to know about spread trading. Remember the example that Kevin gave about the 4 trades, that one of them goes against you and it just wipes you out? This is what we're focusing on in this course. How to make that 4th trade not blow away your profit and some of your principal. How to set the trades up correctly so they can be adjusted. This is taught through 22 online classes. Most of the classes are just a little bit shorter, so it's about the same amount of information, but it's taught through 22 online classes. We have a weekly newsletter that goes with this program. This may be one of the most valuable pieces of our program, so I need to tell you about it for just a minute. This weekly newsletter that we send out every Monday, with the exception of a holiday, a major U.S. holiday, every Monday this newsletter comes out and we place an option-only spread trade in this newsletter. We show you what we're going to trade, why we're going to trade it, why we chose the strategy that we did, what are we seeing in the technical indicators that make us think the stock is going a certain way, what our expectation is for profit, when we plan on getting out of the trade, and most importantly, in advance, we tell you, here's what we're going to do if we're wrong. Here is how we're going to adjust this trade if we are wrong. Because if you don't know how to adjust it, everything else you're learning is worthless. And if you do know how to adjust it, but you're not setting it up right in the first place, the adjustment strategy is worthless. And the best thing about this newsletter, folks, is we send this out before we place the trade. You do not hear about the trade that we made after we made it. You hear about the trade we're going to make before we get into it, so that if you want to get into it, you can get into it at the same price we do at the same time. If we make an adjustment to this trade, you hear about it before we make the adjustment. In between the weekly newsletters, we oftentimes send emails saying, you know what, at the open of the market tomorrow, we're going to adjust this trade by rolling this option to this strike price or this month of expiration. We literally telegraph our moves. I had a student come to me, a potential student come to me a few years back, and he was so upset with another education company that he had purchased that always told him what they did after they had done it. And when he called them out to actually see the trades, to see if they would show him the history of the trades, they couldn't do it. And he knew that they were just BSing him the whole time. It's easy to look at what the market did yesterday and then say to someone, oh, I bought these shares when it was down at $7, and as you can see, it's up at $297 now, and I knew that was going to happen, and if you learn my education, you can do the same thing. That's such a load of crap. I'm sorry. I don't know how else to say it. That's so wrong for people to do that. We show you what we're going to do before we do it, and we literally put our money where our mouth is. If you're in a bad trade that needs to be adjusted, so are we, and you're doing it with us, and we're adjusting it with you. This newsletter, honestly, may be one of the most valuable pieces of this education. We have weekly chat sessions that go with this course also. This course also sells at full retail for $2,500. Anytime someone wants both courses, we're always willing to knock $1,000 off of. So even though both courses would normally cost $5,000, we're always willing to cut that down by 20% and offer both courses for $4,000. We are doing a special offer right now, but I'm going to tell you right now, the only way you can get this offer is if you email us or call us at the end of this presentation, and we'll hold it for you, because at the end of this week, this offer is over, and I don't think we're bringing it back around, at least for a while. This week, through the end of the week, the combined course, both courses, normally worth $5,000, already discounted to $4,000, we're going to do for $3,000. So honestly, folks, for only $500 more than the cost of one of the courses, you can actually do both the courses. If you know for an absolute fact that you only want the Ultimate Collar Trade course, or if you know for an absolute fact that you only want the spread trading course, I will take another $500 off of either one of those courses individually, making either one of them independently only $2,000. But folks, if you do not call us or email us at the information that I just put on your screen, if you don't call or email us sometime in the next 24 hours, I will not hold this discount in place. And at the end of this week, the discount will go away. There's other times when we're offering other discounts, but I know for a fact we have a price increase that is going to go into effect the 1st of September. Every one of our vendors, the people we host these webinars through, the people we host our website through, everybody we do business with to be able to run a business has increased their prices on us since the 1st of the year. We've held off and held off and held off and held off. And finally, the cost of doing business is such that we have to do a small price increase in September. Between now and then, I'm not going to run another promotion on the education course. We'll still do the $4,000 for people that want to buy both courses, but I'm not going to discount it deeper than that. You do not, sending us an email tonight or calling us tonight does not obligate you to buy the education. It does not mean that you are making a commitment to spend $2,000 or $3,000 with us. It means we will hold that discount in place through the end of this week so that you have an opportunity to get your questions answered. You can email us. You can call us with questions. Some people don't like to have a verbal conversation. They'd rather go back and forth with emails. Fine. That's not a problem at all. Other people would rather hear your voice and talk to you and ask their questions. That's fine. We'll help you out either way. Our toll-free number is up here. I suggest you write it down somewhere. You can't just click on this and send us an email. You actually need to write it down, but it's pretty simple. info@safeoptionstrategies.com. If you will email us or call us tonight, you'll probably have to leave a message if you call because it's our phones are pretty busy, and I can't guarantee you'll get right through to someone. So you'll probably have to leave a message, but if there's a message left, we're going to honor that. That's all you have to do, and we'll hold the discount in place for you. Now, Kevin, I've had a bunch of questions come in. Is there anything that you want to add while I read through a few of these questions to make sure that I'm not going to read the same question over and over again? And then, folks, if you have other questions you want to ask, now is the time to ask them.
Well, Jeffrey, I was just going to make the comment that in real life, if more people would do what you would teach them, it would probably put me out of business. It's the same strategies I use to protect people's portfolios. I'm appreciative that you let me stay on with you, and I guess those that are here tonight, I would hope that you would each ask yourself the hard questions. Obviously, you'd like to do better, and I think this is a great opportunity to do so. Jeffrey, I appreciate you letting me be here today, and let's get these questions answered.
All right, let's dive right in. There's not a whole bunch of questions. We had a pretty big group in, and I'm surprised we don't have a few more questions of this, but that's okay. There were two different people that asked questions that were similar, and I think I addressed them already, and it just had to do with the different strike prices of long puts, and could you buy a put that was farther in the money? Could you buy a long call that was farther in the money? And this is when I was showing the caller trade on Best Buy, and then the short answer is yes, you could. As long as you can keep track of your cost basis, know what your risk is, know what your reward is, there's not a have to do it this way or have to do it that way type of thing. It's what are your limitations and what are you willing to do and what do you desire to do, and that's what you need to be focused on. That's what you need to be paying really close attention to. So the answer to those questions is yes, you could use other strike prices, you could use other months of expiration. There's nothing wrong with that. I think I did an okay job of explaining why we set it up the way we set it up. Hopefully I did an okay job of that. All right, next question. Somebody wants to know if we teach anything, or actually if these strategies are applicable to commodities. We've got a commodities trader in with us. Kevin, help me out here. I believe you can. I believe some commodities have options you can trade on them.
Yeah, short answer is yes. These do work. Sometimes you do have the commodities, though, that trade more of a European style. Okay. The short answer is yes, though. Okay. They are available. They could work. They will work better with an equity, U.S. equities, but they are definitely applicable for overseas in Europe and or for the commodities option trading as well.
Okay, thank you. Kevin's been through all the licensing and so forth. And the reason, not at the risk of sounding unintelligent, it's a harder question for me to answer simply for this reason. I teach these strategies around U.S. equities. So that is where my focus and my time are spent, is teaching it around U.S. equities. But I know I've had students that understand commodities on a very high level, and they've been successful doing it with commodities. But honestly, they know more about commodities specifically than I do. Somebody asked a question about why would you have a short call so far out in time, and then they kind of answered their own question by putting because of the bigger credit with some question marks, and that's actually correct. The answer is yes. The reason we went so far out in time on that short call is, in fact, because of the large credit that we got on it, but there's a little bit more to it than just that. It's important to know that you have the ability to roll that short call into a closer expiration, up to a higher strike price, down to a lower strike price, and you can sit on that covered call even when it's deep in the money. If the stock price takes off to the upside, and Best Buy, for example, was trading way over that $33 a share, the odds of you getting called out on that are so incredibly slim. There's nothing wrong with just leaving it where it's at. It's really, truthfully, just no big deal to leave it where it's at. The time will come when another option will become available, the January 2017s, and you will be able to roll to a higher strike price and not do it for any negative effect on your cost basis of your trade. And we teach how to do that. And that's the short answer to the questions. We teach how to do that. The next two questions that came in, I sort of glossed over this really quickly, so it's worth maybe giving a little better explanation on it. But two different people asked in a slightly different way about the long puts when it comes to the expiration, if the stock is still trending down. Trust me when I tell you, you're not going to leave those long puts in place the way they are. You're going to add new long puts to the trade. You may do it in the way of rolling those long puts farther out in time and down to a lower strike price. Don't forget that if you're rolling those puts out and down, you've already protected your stock from where those long put strike prices were to begin with down to wherever the stock is trading at right now. That much of it is already covered. You've protected yourself. So having a new long put at the current price of the stock, or where the stock is at the time you're doing this, doesn't mean you're losing out on or giving up that other profit that was in there. And that's also very important to understand. But we do a really good job of teaching when the timing is right to do that, and teaching you how to do that. And it works in conjunction with where that covered call is, and so forth. So it's all covered very well in the education program. Individual, I was just about to say that we're caught up on the questions because there weren't a whole lot of them, and someone typed in, any guarantees with the program? Yes. Folks, if you purchase either one of the two courses, or if you purchase both courses, as long as you will complete all the classes and trade using this methodology for at least 6 months, if you are not profitable to the tune of what you spent on the education course, I guarantee a refund for you. I will refund your money. I'm that confident that if you will finish the classes and then put the methodology into daily application, you will profit at least to the tune of what you paid for the education, or I will refund your money. And I put that guarantee in writing for you. That is not something that's just a verbal commitment from me. That guarantee is in writing. Someone is typing in a question right now. Any type of payment program. That's a hard question, and let me tell you why. I'm tempted to say yes, I can work something out with you. Let me tell you why I hesitate just a little bit on answering that question. If you can't afford or can't come up with $2,000 to purchase an education like this, you maybe ought to consider whether or not you should be in the market. That's number one. I don't mean any insult by that, but if it's that big a stretch for you money-wise, you may want to consider whether you should be in market or not. If you need a payment plan, my understanding is that's what credit cards are for. You put it on a credit card, and they let you spread those payments out over time. And if you don't spread them out over too much time, you don't pay too heavy a load on interest on that. I will tell you this, folks. If you really want to do this program, and it would be a little bit difficult for you to come up with the money on a credit card right now, or just come up with it in one shot, give me a call and let's talk. I'm willing to have a conversation with you. I'm not making any promises. I've had mixed success. I've set up some, payment programs for people and had them follow through very studiously. on making the payments. I've never had to remind them. My secretary, my operations manager have never had to send them emails or for lack of a better way to describe it, chase after them. And I've had other people that I've set up on payment programs, and they make one payment to get started, and we never hear from them again, and we have to decide when do we cut off their username and password. It's kind of a tough question. I'm willing, if you're willing to give me a call, I'm willing to have a conversation with you about it. You'll have to explain to me a little bit. You don't have to give me your whole life story, but explain to me a little bit your circumstances, and we'll talk. One other thing I forgot to mention, because someone just typed this question in: if you are a veteran of U.S. Armed Forces, I spent some time in the United States Army as well. If you are a veteran of the U.S. Armed Forces, I will offer you another little bit of a discount. Call me and talk to me about that. I love to help out our veterans. And for those of you in other countries, I certainly don't mean any offense by that, but we're an American-based company, so that's for U.S. veterans. One last question coming in: what happens when the stock price remains the same and the long puts expire? Well, the answer to that question is actually you would not allow the long puts to get to expiration if the stock goes stagnant. The easiest way for me to answer that for the individual that asked that question is we teach you very thoroughly what to do if you get into a trade like that. And we try, number one, let me back up a little bit. We try and do this type of a trade, that collar trade, on stocks that don't have much history of being flat. We really look for companies that have history of big movements. Now, past performance never guarantees what a company is going to do in the future. History is never a guarantee of the future. It's an indicator. It's one indicator. So for that reason, if a stock were to go somewhat stagnant for more than a week or two following us getting into a trade like that, we will make some adjustments to that trade. One of those adjustments is going to be rolling those covered calls in to a shorter expiration date and probably a lower strike price, and running a little bit of a covered call strategy in conjunction with our stock. We're probably going to turn some, if not all, of those long puts into some type of a put spread trade strategy, something like a put calendar spread or a bull put spread. I really strongly recommend to people that they get both courses if they can afford both courses. That is my strong recommendation. If an individual cannot afford both courses and they had to do one or the other, I would say learn to do the collar trading course first. That's, again, just my recommendation. You can do whatever you want. But learning both courses allows you to put together these collar trades, and then you have additional things you can do with those options if something were to, in fact, not go the way you wanted. So those trades definitely work better when you get big movements up or big movements down. And when you get something where it flattens a little bit, it's great to know how to adjust that into some type of a spread trade. So great question. I appreciate that question, and hopefully that answered it for you in a way that made sense. I do think now we are caught up with questions, and certainly as soon as some people realize that we sell an education, they immediately logged off. So the large class group that we started with has dwindled somewhat. If you don't have any other questions, folks, I'm going to go ahead and sign out. I'm going to let Kevin get back to what he's got going. Please give us a call or send us an email. Let us know if we can be of help. Kevin has unmuted his microphone now and is probably typing a answer to somebody's question. Kevin, any last comments since you've unmuted yourself? Love to give Kevin a hard time when I can.
I actually just lost my internet there for a second.
Oh, we heard a little background static, so you must have lost it and got it back.
Lost and got it back. Hey, I just, again, appreciate you having me here, and don't teach it to too many people or they'll put me out of business.
I'm not trying to put Kevin out of business. Kevin is a good friend and a trusted advisor. He helps collaborate with me on a lot of trades, and I love referring people that Kevin has a minimum amount of money that he'll trade for people. You have to have a minimum net worth to be able to have him as a broker. I love being able to refer people his way, because oftentimes people with that kind of money want a broker to manage at least some of it, and then they'll learn how to do the education for the remainder of it. Most of the people that come to this presentation that you folks are hearing probably have a portfolio that they want to manage it themselves, and so every once in a while, Kevin will refer somebody back my way. So we have a good working relationship that way. I'm not planning on putting you out of business, Kevin. Folks, I'm going to sign off. For those of you that have stayed on, thanks for giving up that extra 20 minutes. We try and keep this presentation to about an hour, but usually with questions and answers, we go a little bit beyond that. Thanks for listening. Send us that email. Give us that phone call. We'll answer your questions. We won't give you any high-pressure sales pitch. We won't try and talk you into the program. We will answer your questions as thoroughly as we can. If it's the right fit for you, I'd like to hold that discount in place for you, so don't forget to send an email or call and leave us a message so that we can hold that discount in place for you. That's the only way we're going to hold the discount, and that discount's not going to be around after this week. Thanks, everybody. Bye-bye.